Hi, Pat Strubbe from Preservation Specialists, and this month our focus is all about inflation. Do you remember the good old days when we were told inflation would be transitory? Well, the most recent report is that prices are up 7.9% in the last year, and I am quite sure if you are like me, you are feeling that, whether that's at the grocery store or at the gas pump or so many other places. In fact, some experts are expecting inflation to continue to rise and maybe peak at about 9% over the next few months. Now, the Fed has finally responded and began raising interest rates last week. Most people expect that to continue throughout the rest of this year. So, the thing we always want to come back to is how does this affect you? It could in two very different ways. The two questions we get all the time is how is this going to affect my money, my investments, and how is it going to affect my retirement? Well, let's start with your money and your investments specifically. While savers and retirees have been dealing with close to 0% interest rates for a long time, they may be relieved that their bank account might pay more than about 10 cents a month in interest, but we don't expect interest rates to get really high. No one's expecting 5% CDs or anything like that. So the two areas with your investments that would be most affected is certainly we know that rising interest rates are bad for bonds. It's a seesaw or teeter-totter. When rates are going up, the value of bonds are going down. So definitely one thing to check on. If you have a portfolio, certainly in like a brokerage account, we want to make sure that you have very little in the bond market. And then the second thing is, historically speaking, in inflationary times, real estate has done quite well. We've seen that over the last year, and most experts expect that to continue. So these are the tried and true things. We've been avoiding bonds with our recommendations for quite some time. We've been waiting for these rising rates. And of course, as we always say, it's why we diversify. No one can predict exactly how this is going to affect everything. So we want to divvy up your money and make sure it's protected by spreading that risk. Now, how does it affect your retirement? Look, we know that costs are up. And we know that it's likely to stay that way for a while. So we talk about our custom-built retirement plans being specific to you, and we know that they may need to be adjusted along the way. So we've already had some of our clients contacting us saying, the last few years my income has worked out fine, but things are getting a little too tight, so we need to reevaluate how much we're getting every month. So this is where communicating with your advisor is key. If things are getting tight or if you're worried about this, definitely let your advisor know. As we always say, if you're wondering if your retirement plan is prepared for this, if it's prepared for inflation, contact us right away. Talk to one of our advisors. Thanks very much, and we look forward to seeing you next month.